Hello and welcome everybody to this quick chat with James Davolos. He works for Horizon Kinetics. James is the vice president and portfolio manager for them. Today we're going to be talking about inflation and how it impacts the markets and go into depth about their inflation beneficiary ETF, ticker INFL. And as always, I will include a link to their organization down below. So, James, before we get into things, can you talk a little bit about yourself and your experience in the markets?
Sure. So I've been with Horizon about 16 years now. I joined them straight out of undergrad, and they were really great in allowing me to pursue my MBA at night while I was still working for them. But I guess I'm only 30. I say only 38, but I'm unique relative to a lot of people in the industry because I've actually seen a market that went down a lot and stayed down. So I started in late 2005, and I thought, this was the easiest thing on earth, just watching stocks go nowhere but up from 05, 06, and 07. We owned a lot of financials and a lot of the stuff that was doing great back then, some Chinese stocks and commodity stocks. And then you all know what happened in 08 and 09, but I think a lot of that experience shaped me and kind of differentiates me from a lot of other people, where I kind of saw how good it could be, but then the rug pulled out. So I think that was a really formative experience, but also the fact that I was able to work with people that really don't panic, don't overreact to the market short term, and really think things through. Enabled me to kind of take a step back, slow things down, and try to understand why things were happening and what was likely to happen in the future. So, really interesting kind of time and place to join the market. And I'm really grateful for that.
Wow. So you said you've been around since '05. So you have what now, 16 years of experience in the market?
Yep, that's right. So, been in a lot of different roles, but all at the same firm, and always kind of evaluating different investments and different investment regimes. So it's, I got to say that it is really different today in the past couple of years from when I started. And I think that that's why it's an opportune time to have the discussion that we're having.
Love it. So what do you feel is the biggest change from back in '05 compared to nowadays?
I think the biggest is that, I know that one of the things that is, I call interest rates gravity to financial assets. So higher interest rates mean it's a higher borrowing cost, and your opportunity cost is higher. So in 2005, if you thought a stock was too risky or too expensive, you could park that money in a bond and get 6 or 7% without taking a crazy amount of risk. And go out and look today what you need to do to get 7%. You'd probably have to invest in the debt of a Mongolian turquoise production company that has no revenue. And that's an exaggeration, but the amount of risk you need to take to get a 7% yield today is pretty extreme. And today, now there's basically no yield in debt markets. So there's, the adjective TINA, there is nothing else. And I think that's why a lot of people have flocked to equities and have over extrapolated a lot of growth assumptions. And that interest rate and inflation dynamic is just so important in psychology and how people invest and think about risk.
Love it. So let's bridge now into inflation. Obviously, everybody has heard the term, and the majority of individuals who will be watching this video understand what inflation is. But can you explain inflation on a little bit deeper of its little scale, so then the newer traders onto the stock market and anybody who doesn't understand inflation are able to understand it?
Yeah, and I think that's really important. So there's, I think, an academic framework of inflation, but then there's also a real world framework of inflation. And so let's start with the former. Academically, inflation is just too much money chasing too few of goods. So you increase money supply, which we've grown 40% over the last year, give or take. The result is often going to be higher prices of everything that you buy, whether it's an iPhone or a dental exam, so goods and services. And so academically, you also kind of always equate more money chasing fewer goods. And in the US, we define inflation by the consumer price index as well as the PCE index, which are very similar types of price gauges, but maybe it's beyond the context here. I think a lot of people would argue that they understate their real world inflation example. So real world is what expenses are going up in your life relative to your earnings. So if you have a job and you're making X, and let's say you get a 3 or a 5% raise every couple of years, but your rent, your food, your vacations, your clothing, everything that you kind of prioritize in your life is going up faster than your wages and economic growth, then that's real world inflation. And I think that a lot of people, there's a lot of ambiguity around what is actual inflation. But I think at its core, it's basically the things that you want to consume are going up and going up in many cases faster than your income. And that's where the problems really start.
Love that. So like you said, a lot of people talk about how inflation is constantly impacting the price of goods and services that they are actively purchasing. Now, can you talk a little bit more about, the meat of the reason why we're having this call, how inflation impacts stocks and different organizations differently?
Sure. I think that there's two ways to approach it. One is how the companies operate, and then two is the valuation. So let's start with fundamentally how do companies operate. I think it's pretty easy to argue if inflation is rising, that most good high quality companies can push on those costs to their consumers. So if you have a boutique hotel in Hawaii that there's only 100 rooms in, inflation's 5%, chances are you can push on 5%, no problem. Mm-hmm. If you're Apple, people have a infinite propensity to want the new iPhone, AirPods, Apple Watch, iPad, whatever it is. Sure, you can push it on. The problem though is, can you push on more price than your cost of goods sold and then your expenses? So with the hotel, your labor is obviously your number one cost, but also your food and beverage, your marketing, your electricity. With Apple, it's semiconductors, it's wages, it's marketing. And so that's where it gets really tricky, because companies are so profitable today. If you can raise your price with inflation, that's one thing, but to be able to do it without having the same or more costs, that's a much trickier scenario. And I think that's something that a lot of people miss when they say, oh yeah, equities will do fine. The inflation argument on valuation is more, does it impact interest rates? And so as we sit here today, you can borrow money or you can lend money to the United States government for the whopping rate of 1.35% per year. So think about that. Do you want to lend your money to the government for 1.35% pre-tax? So, if you're getting taxed on that, that's less than 1%. If the market were to believe and inflation were to sustainably be at 2, 3, 4, 5, 6%, you're losing money in real terms. And what I mean is in inflation adjusted terms. So if you're lending at 1.35 and inflation's at 5, you're losing almost 4%, 3.65% on a real basis. And so reflexively, in most inflationary environments, interest rates go up. Now, the government is obviously influencing interest rates through a lot of mechanisms today, again, probably beyond the context of this conversation, but to the extent inflation makes people revisit how they view interest rates and their cost of capital, valuations tend to go down in the broader market.
Really? So I would think that in the grand scheme of things, as the price of the US dollar comes down and the value of it comes down, these organizations that have a set evaluation would naturally tend to increase over time as the price of the dollar does come down. Is that not the current impacts in the market?
Yeah, so you're touching on another interplay here, which is the currency and the dollar. So, weaker dollar means that it's basically you can't consume as much abroad. But there's a lot of different research on how stocks have performed through different inflationary cycles. And I think the biggest factor is, what are the valuations relative to interest rates? Mm-hmm. So today, arguably, you have some of the highest valuations on record, depending on which stocks and sectors you look at. So a very small change in those valuations can result in a lot of losses. So when I was kind of starting out in my career and before I started my career, I just kind of thought, hey, is it an interesting business model? Is it growing? Is it a great company? Therefore, it's got to be a good stock. But if you pay just a wildly optimistic valuation for that great, amazing company, there can be a lot of pain.
So what are your thoughts on inflation, in the short term as well as in the long term? Because as of right now, a lot of retail traders are starting to speculate on inflation. It's actively on the news. I've heard it brought up in the gym multiple times in, the past couple of weeks. What are your thoughts right now?
I think that you don't really, there's not too much to glean into short-term moves, but let's just assume that inflation, we've been up basically 6% or so over the past year. Let's just assume that we go back to 2% for the next year or two. I don't think that's my base case, but all else equal, you've gone up 6, then you go up another 2. So your cost of living is up 8%. So if you haven't grown your wages, grown your assets, grown all of everything in your life by at least 8% compared to pre-COVID, you're underwater in inflation adjusted terms. And so everybody gets caught up in inflation, which is the rate of change year over year. Mm-hmm. But let's give an extreme example. Let's say inflation was 100% this year, and then all of a sudden it went to 0 for the next decade. Mm-hmm. You're still devastated. I mean, how would you feel about paying twice your apartment rent and then, okay, fine, it's flat for the next 10 years, but that's still a big problem. So people get really caught up in the rate of change, but I think what you need to focus on is the trajectory, and the trajectory is higher. And admittedly, it's going to level off because you go from $30 oil to 70. Chances are you're not going to go to $140 oil, which is a big part of inflation. Mm-hmm. But inflation also hasn't really caught up and captured wage growth or housing prices. So that's a long-winded way of saying I think the trajectory is to continue to be higher, but that incremental rate of change might slow down, but it's no less pernicious in how it affects your life and companies.
So now let's start to move in a little bit more into what you guys are currently doing over at Horizon with your inflation beneficiary ETF. That's kind of difficult word to say. Can you talk a little bit about INFL and what you guys are currently doing in the process of setting it up?
Yeah. And so one of the big points that I tried to make earlier is that to really benefit from inflation, you need to invest in companies that can grow revenues without having commensurate costs. Mm-hmm. So what we focus on are companies that have what we call hard assets. So a physical, tangible asset. Can you see it? Can you kick it? Can you touch it? But the business model is capital light. So you don't spend a lot of money to make money, and you don't use a lot of debt. Mm-hmm. And so we've identified business models that have exposure to energy, agriculture, precious metals, base metals, real estate, automotives, industrials, even healthcare and media, where they have a lot of pricing, but the business model is such that they might grow revenue 20%, but costs might grow 1 or 2% because it's what they call you have a fixed cost structure with minimal variable expenses. So the fixed cost is what your cost of waking up every day is, but to have 50 more units sold, your variable expense is next to nothing.
I love it. That is actually amazing. So what are typical organizations that you're looking for? You said you're looking at metal miners, you're looking at oil, all these different organizations. Is there any that you specifically are very interested in?
Yeah. So again, let's think about a mining company, for example, and why we don't own a mining company per se is that, you got to find somewhere to dig a huge hole. Mm-hmm. And you got to spend maybe a couple $100 million, if not $1 billion to dig that hole. You need to then get infrastructure to get it all to a port. You got to ship it around the world, pay a bunch of staff. So you're spending a lot of money before you ever get any revenue. Mm-hmm. What we like, and the best analogy I like is a toll booth. Mm-hmm. So you build your toll booth and everybody gives you $1 to go through that toll booth. You're basically just, if you have 100 cars a day, or if you have 2 cars a day, it's basically the same expense. You've got your toll booth.
Mm-hmm.
So what I like to focus on are toll booths, where the throughput is basically all revenue. So we own what are called royalties on metals and energy.
Mm-hmm.
A royalty is where you just earn a financial override on somebody else's energy operation.
Mm-hmm.
And basically what that creates is this toll booth type of model. Another is a financial exchange. So whenever you log on and buy stock XYZ, that stock exchange is actually earning a small amount of money on your trade.
Mm-hmm.
And if you think about what they're doing, all they're doing is matching the buyer and seller electronically.
Mm-hmm.
And to do that for my $50 trade in my personal account or a $1 trillion trade from a sovereign wealth fund, it's the same computer. So it's all revenue to them. And again, that toll booth model is what we really try to emphasize.
That is amazing. So now let's talk a little bit more about how to utilize INFL in a average retail portfolio and your recommendations on how these retail traders should start to use INFL in either their daily trading or just using as a hedge against inflation in a long-term portfolio.
Yeah, and well, I think a lot of retail and a lot of especially younger people have done extremely well in these really high growth, interesting tech stocks. And there's nothing wrong with that. And I think that there's merit to those investments. And it's honestly not my expertise, but INFL and these types of businesses have the potential to zig while those stocks zag, if you will.
Mm-hmm.
Meaning if interest rates move higher, if inflation moves higher, if different type of economic variables that have been very supportive of those companies for the last 10 years shift, it could end up being a very difficult environment for them and very good for the INFL companies. So whether you're a tactical trader and you basically want to trade in and out of your portfolio and then use INFL as kind of a complement, or if you have this core holding of growthy companies and say, hey, why don't I own some INFL on the side because it gives me a bit of diversification away from the other stuff I own.
So typical allocations right now, we have the smart retail traders that are actively, diversifying their portfolios, making sure that they are spread amongst a bunch of different solid blue chip companies. And then there are people who, are kind of the YOLO mindset, ape nation trying to go to the moon overnight. I'm assuming that you are talking, for the long-term sake of those types of investors, that the solid, safe retail trader should be hedging their portfolios with something like INFL, but compared to the guys over there that are trying to get rich in the relative short term, INFL is not really going to be a great allocation of capital, correct?
Yeah, exactly. We're not, this is something that tries to smooth out a long-term trend. And if you want to make a big directional bet on energy or precious metals or agriculture, there's ways to do that with a lot of leverage. And the problem with that, and the reason that we don't own those, is it's binary. And what I mean by that is heads you win, tails you lose. Mm-hmm. So in a lot of these investments, if you're right and you time it perfectly, sure, you can make 20, 50, 80, 100% in a year. But if you're wrong, you could lose, again, 30, 50, 70% in some of these investments. And so that's why we try to smooth it out and give you something where this should kind of benefit your overall allocation longer term.
Love it. So now we've talked about inflation. We've talked about how it impacts different organizations, as well as now talking a little bit about INFL. How would you compare a hedge against inflation with something like gold, something like Bitcoin, and then using your ETF INFL? How do you feel those will perform over the course of time?
Yeah, and I really like gold and I really like Bitcoin. A lot of conventional asset managers don't love either of them. Mm-hmm. The pejorative diss, if you will, for gold is like, what are you going to do with a shiny rock? Or how much cash flow does a shiny rock generate? And depending on the people, I've heard crazy types of insulting things thrown at Bitcoin. And a lot of the people just didn't take the time to understand it. And, maybe to your audience, I'm bordering on being a boomer, but even my friends, I tell them, you can't learn it and understand it before you have an opinion on it. Otherwise, you're just ignorant. But again, they're very different animals. Gold, you need to understand one thing about gold. It is very, very, very sensitive to the US dollar.
Really?
So on days, oh yeah. Gold, if you see gold prices, right now I see the gold price on my Bloomberg telling me it's at 1785, so $1,785. That is not the price for you to go to the US Mint and get an ounce of gold. That is a paper future. It's a derivative traded on the COMEX or the New York Mercantile Exchange. And it's settled in paper. So again, it's not physical settlement. And I think that's really important because paper traders, meaning derivatives in these financial markets, they're trading a lot of them on patterns and correlations. And one thing that is always bad news for gold is a rising dollar because gold is priced in dollars. So all else equal, higher dollar price, lower gold price. The other thing is what's called a real yield. So if yields go up bond yields relative to inflation. So just understand those two short-term dynamics, both interest rates and dollar when you think about gold. But I think at the end of the day, to the extent that the world is just going to print more dollars, euros, yen, and pounds, everything's going to go up that's finite and tangible. And so I like gold long-term. Crypto, I think, has just such an infinitely wide outcome, but be ready, willing, and able to get, for a lack of better words, punched in the mouth, where, Bitcoiners are real Bitcoiners do not worry about a 20, 30, 40, 50% drawdown because it's happened so many times. It seems as though there's enough institutional adoption and liquidity in the market now where maybe the volatility is going to compress a little bit, but I see scenarios where the wide outcome for Bitcoin and crypto is just so phenomenal. And again, there's only going to be 21 million Bitcoin ever minted. If there's going to be trillions of more dollars added to the system every year, all else equal, that makes Bitcoin that much more finite and valuable, in my opinion.
Wow. So that is actually a great way for you to describe it. So, you went over gold, went over Bitcoin. Can you talk a little bit more about your beliefs on the long term of INFL?
Yeah. So a lot of these companies are trading at pretty good valuations. And what I mean by that is they're growing. They have exposure to all the places you want exposure to. And by and large, the portfolio is trading at an average of about a 5% free cash flow yield. So what that means is if you took the earnings of the company after all their expenses and reinvestment, you could put 5% in your pocket a year while the company is still growing. So that's a pretty good deal in today's world. Compare that to some of these tech stocks that don't have free cash flow or negative earnings, or, let's say 50 times cash flow, that's a 2% yield. So I think that's a really important dynamic to think about is we're buying good businesses at good valuation. So let's say, again, we just hang out with 1, 2, 3, 4% inflation, and I'm not right, or I'm not wildly right on my inflation thesis. I think we grind out pretty good returns. Certainly far more attractive than the broader market or fixed income. It's when you start talking about much higher levels of inflation that these companies can really do well, when I think a lot of other assets might struggle. And that's why I think it's such an interesting allocation today. So what I like is what I call asymmetry. Your downside is not commensurate with your upside. So, status quo, I think I do okay, but as you get higher levels of inflation, I think we have an asymmetric payout to the upside. And honestly, that's what finance is all about. Just getting good upside relative to your risk. That's really the name of that's really kind of unless you're in sales, if you're in investing, that's really the name of almost every trade. Get upside for cheap or free.
So now that we've talked about, gold, Bitcoin, and INFL. Do you have anything that you want to talk to these retail traders about? Is there anything that you want to say? Any words of advice?
I would just say be careful. And I don't want to say that just it's things have been, and obviously today in the past week, even 2 weeks have been really tricky, especially in a lot of these high growth names and the SaaS names. But it's deceiving how easy it's been for some people to make just a wild amount of money over the past couple of years. And maybe there's still going to be opportunities like that, but I started again in '05 in a very different regime. I experienced '08, '09, and a lot of kind of the choppier markets of the recovery out of the global financial crisis. And the markets of today are like nothing I've ever seen, and people that have been in the business for 80 years have ever seen. And it's just kind of hubris is the most dangerous thing that I think you can have in this business. And everybody's kind of at the end of last year and even through half of this year was, kind of giving themselves a pat on the back, but, understand the risk you took and understand how much you can lose. So, if how much do you have in the market relative to how much money you need, whether you have a car payment, a, student debt or an apartment lease. So just understand all of that and understand that, it's good to get humbled, but understand that, there is downside.
Yeah. Oh my God. Yeah. Just
because, Alan, to be honest, I made that mistake. I thought I was on top of the world in '07 after 2 years. Smartest guy. Nobody knows better than me. I'm 24. No, I'm too smart. I know better than you. And I had way too much exposure going into '08, '09. And I mean, it was touch and go there if I was going to pay rent.
yeah. Oh
So
my God.
don't do that.
I feel like everybody, all these successful traders, though, have that exact same story. It's just part of the Dunning-Kruger effect. You get into the markets, you start killing it right away. There is nothing to oppose you. You're just making money hand over fist. And then just that one event that decides to take everybody out and makes them all just humble right away.
Yeah. And I think I was not smart enough to know how like arrogant I was. And like now it's in hindsight, I'm just like, wow, I can't believe I was like that.
Yeah. That's part of the fun of everything, right? Welcome to the stock market.
Yeah.
But cool. All right. Is there anything else that you would like to say, James, before I let you go and enjoy the rest of your night?
No, take a look at the fund. I think there's a lot of interesting holdings. We have a lot of good literature on our website, a lot of podcasts, interesting things for people that are interested. So our website has a lot of information and interesting stuff for people that want more info. And I encourage you, if you're kind of a stock geek like me, dig into the holdings, look at the businesses, look at the business models, and enjoy it. That's why you're doing this. It's fun and it's stimulating.
Beautiful. And hey, one more question that I forgot to ask you earlier. So touching back on the holdings that you currently have, trying to play devil's advocate here, why should somebody invest in INFL compared to looking at the holdings that you guys currently have and then diversifying into those specific holdings too?
Yeah, I think that we balance a lot of different risks and a lot of different exposures very deliberately in the portfolio. Mm-hmm. So I understand where my exposure to interest rates, to currencies, to ag, to gold, to energy, to healthcare is. And I think that you really want to make sure you cast a wide net and balance those well to really benefit from inflation. Because when I see how a lot of other people try to play this, they're so laser focused in a couple different areas of inflation, where if we have runaway inflation, but those specific drivers don't move, then you're kind of standing still or losing money while inflation runs away. So directionally, you're right, but investment wise, you're wrong.
All right, everybody, that is James Davolos, correct?
Yep.
Perfect. Again, he works for Horizon Kinetics. I'm going to post a link to them, as well as the ticker again is INFL for their inflation beneficiary ETF. If you have any questions for me, you can always reach out to me. And James, if the community has any questions for you, is it okay if I relay some of those questions to you?
Absolutely. We'd be more than happy to.
Perfect. All right. Thank you so much, James, for your time. Hope you have a great day.
Thanks. You too, Alan. Take care.